and Blue Rock Finance. My name is Jamie King and I'm the Managing Director of Blue Rock Finance, and I'll be your host for today's webinar. For those of you online today who don't know what Blue Rock is or does, Blue Rock is a multi-facet professional services firm that specialises in accounting, financial planning, law, digital, and my area of interest, finance. At Blue Rock, we cater to SME businesses who like the flexibility of having the professional services catered for under the one roof. Our offices are located at 414 Latrobe Street, Melbourne CBD. That's of course when we're obviously not in lockdown and operating from our armchairs and our couches, given the current restrictions. More specifically, from a Blue Rock Finance point of view, we're essentially a mortgage broking service that operates as an intermediary between the banks and our clients. The ultimate aim for our business is to ensure that our clients are accessing the most competitive financial products in the market. And we have three specific key products that we deal in: home lending, commercial finance, asset finance. Okay, so before we get stuck into the content today, I'd like to just do a quick whip around to our panelists and introduce our presenters for today's webinar. Today we have presenting from Blue Rock Finance, Alex Theodoro, who is one of our senior relationship managers. Hi, Alex. And we also have David McMillan and Phil Almeida from the directors, of Performance Property Advisory Group. So, hey, Dave and Phil, how are you going?
Very well, mate. Thanks for having us.
Thanks for having us, Jamie.
Excellent. So just before we jump into the content today, Dave, we might just shoot quickly over to you, just to give us a brief description on who and what Performance Property Advisory business does and is. So I'll just quickly shoot over to you, Dave, if that's okay.
Thanks, mate. Yeah, look, Performance Property's been going for about 10 years. We help time poor professionals, doctors, business owners, expats, executives build property portfolios between that sort of, most of our clients are anywhere from sort of 2 to 3 mil all the way up to 50 mil in terms of portfolio size. We put together the strategy that involves, putting the strategy together, doing the market research, buying the properties, buying their prestige homes, and eventually managing their properties as well.
Excellent. Beautiful. Thanks for the intro there, Dave. Just to let you guys know on the webinar today, there is a Q&A button just at the bottom of your screens. So if there's any questions throughout the presentations from Dave and Phil and the presentation on the finance area from Alex, just pop your question in that box, and we'll aim to obviously answer that at the end of the presentation. All right, so we might just throw over to you again, Dave, just to commence your presentation and just to give us obviously an update on what's actually happening in the property market. I know from a finance perspective, we're getting a lot of questions from our clients, vendors and purchasers in the market as to whether or not now is a really good time to sell their property or to buy their property. Obviously, we've just come out of the COVID period. We've got a short spring period coming up where we can execute on transactions up until probably around Christmas. So I know all the people on this call will be interested just to see your perspective of the market short term and medium term. So I'll hand it over to you guys.
Thanks, mate. Thanks, Jamie. I'll just share my screen if you don't mind.
Sure.
Just let me know. Can everyone see that? Hopefully that's come through. Yeah. All right, perfect. So as I mentioned, core to our business is market research. We spend $500,000 a year on researching the market. This data business actually predates Performance Property itself. It's been running for about 10 years, and it enables us to understand, what's going on in the marketplace. And a lot of those findings you'll see today. Most of our clients throughout their journey will buy a prestige home. So we've got a dedicated business that buys prestige homes all across the country. Our business, Performance Property Advisory, is our main business, and this is where we put together property portfolios for clients. And lastly, we manage most of the properties that we buy for clients. So just a bit of a disclaimer. Today, the advice is of a general nature only. Should you want specific property advice, please contact Blue Rock and they will hopefully send you to us, and we can sort of assess your specific circumstances and give you specific property advice. Snapshot of today, we're going to talk about what's happening in the market right now, how to make good decisions, not just through this COVID crisis, but through any crisis, really. What are the key drivers right now, our medium-term price forecast, and our current advice. So what's happening in the marketplace right now? Look, contrary to what the media sort of had everyone panicking about back in March, April, you know, we really never saw discounting across the board. There was some panic selling in March, in April, but after that, there was really no discounting on A-grade stock. And certainly what we're seeing now is in Melbourne is prices starting to rise, specifically on houses and quality houses. Sydney's very much the same. We're seeing no discounting on A-grade stock, and we're definitely seeing that market start to rise. And I think if you look at year-on-year quality real estate, quality homes in Sydney, it's probably up at least 10%. Some discounting on B and C grade stock, but I suppose that's always the case. I don't think that we've got abnormal discounting going on inferior stock. And when I talk about B and C grade stock, I might be talking about high density apartments, or I might be talking about houses on main roads. We are seeing a little bit of discounting, but not so much that it's unusual and it's COVID driven and we're worried about the market. And our core buying markets. So from an investment perspective, we find markets that show value. Those markets at the moment are Adelaide, Brizzy, Bendigo and Perth. And in those markets, what we're seeing is no evidence of discounting. And in fact, we're starting to see evidence of really strong price rises. So, you know, there's been a lot of talk in the media about, you know, when the government stimulus comes off, JobKeeper, JobSeeker. There's also been talk about when the banks call in people who have put their loans on deferral. But we haven't seen any evidence of forced selling in the last 6 months, really. And in fact, we've seen less evidence of forced selling in the last 6 months than at any time I've been in property. And the reason why is because the banks aren't forced selling yet. Now, my understanding, talking to people very senior in banks, is they're going to give people time to get back on their feet. They're going to give time for the economic restrictions to be lifted, to give these people the chance to get their businesses or their employment back up to full speed before they call in the debt and push the properties out. And I don't think they're all going to do it in one quarter. Like speaking to CBA and NAB and ANZ, you know, they've all got different plans. And what I can understand is they're probably going to stage it over 12, 18, 24 months. So I don't think there's going to be a quarter where all the forced sales hit the market and crash the market. And I think that's really important because that's what the media are, you know, they're trying to say, this is how it's going to play out and the market's going to incur some pain. We think if there is pain, it's definitely going to be late 2021, maybe 2022, but it's a big if. I think that the most likely outcome is that these forced sales is absorbed into the market and there's not as many as perhaps the media might want you to believe there's going to be. Now, at the moment, especially in Melbourne, for every one property there's on market, there's properties off market, right? People worried about the market. People don't want to start a campaign because, you know, it's very difficult. Like a couple of weeks ago, the market was closed. Now the market's open, but you have to do private inspections. So there's people out there saying, look, I don't want to spend 5, 10, 20 grand on marketing. But if you've got a qualified buyer, I'm happy for them to come through my property. So now more than ever, if you're looking for a quality home in Melbourne, a buyer's advocate can help you unearth those properties. And there's certainly a good buyer's advocate is certainly worth their money right now. Deals are still being done. Jamie asked me, are you guys doing deals prior to this call? Yes, absolutely. We're still doing deals. A lot of our performance properties buying activities outside of Victoria, but at reduced volumes. And how much reduced? Probably about 30% at the moment is our business. We're a good proxy for the market because we're doing about 300 to 400 transactions a year. And so we're off 30% and we've got a national coverage and we think that's a fairly good indication of how the market's performing. Still transacting, but at reduced levels. In terms of our home buying business, you know, inquiry's still been pretty strong throughout this period. We've had a slight reduction in inquiry. I think the biggest story right now, not just in Melbourne, but across the country, is reduced stock volume. So we've got 30 buyers agents in our network. On Monday morning, we catch up and all of them every week for the past 3 months have told us the same thing. Can't get my hands on quality stock. You know, I've got clients that are waiting to buy, you know, they used to take 45 days. Now they're taking 60, 70 days because I can't get my hands on quality stock. So that is what's driving, that's what's driving our view of the market. Is we believe that demand right now exceeds supply on quality property. And I think importantly, and this is different to other crises, especially the GFC, this is not a credit crisis. Banks are still lending to credit-worthy borrowers. Money's still flowing. It might be harder to, application times are blowing out at ANZ and CBA, but money's still flowing to credit-worthy borrowers, and that's a really important point to distinguish this crisis from other crises that, such as the GFC, where money really tightened up there for a period of time. Now, the other argument to, the market, won't grow is that the government's in too much debt. If you've been watching the news, Australian government debt to GDP is going to wind up about 45% at the end of this year. And this is the government debt to GDP over the last 100 years. And you can see at the conclusion of the last pandemic in 1918, 1919, government debt to GDP was also 45%. And if you think about the 20s were a very prosperous time where asset prices rose and rose strongly, right? So we don't think that the level of government debt is a barrier to price growth. We think it may even encourage, the money supply to expand because there's a lot of stimulus being put in the marketplace at the moment, and that could actually be the precursor to aggressive price growth and not the other way around. When we're looking at this house price forecast, we'll go into a little bit of detail, but I think it's important for us to document how we believe the government will respond through this crisis, because the way they respond through this crisis could dramatically influence our view of where we think house prices are going to go, right? So look, there's four points here. The first most extreme one is, the government's going to increase taxes immediately because they've had to, stimulate the market. We don't think that's the case. And we don't think the government's going to be too loose with their purse strings either. So what we have formed the view that the federal and state government will provide sufficient relief throughout this crisis, and will prioritise growing GDP and getting back to full employment before prioritising paying back the debt. So Josh Frydenberg came out and said this many times. This is the basis of our forecast, and hopefully that makes sense to everyone. So how do you make decisions through crises? How do we, when, we're watching the news every night and, the COVID cases are rising and there's so much uncertainty, how do we make good quality property decisions through crises? And I think it all comes back to one very basic thing, and that's that people have to live somewhere. Unlike the share market, where it can be quite volatile because, people run scared from the share market at times, you can't escape that people have to live somewhere. So if you're in an undersupplied market, which we are in Australia right now, and I'll go into that in a little bit, if people aren't buying, then they're renting, right? And so if prices are coming off slightly, that means that that rents should be rising slightly. Sorry, I thought my phone was turned off. So that's how we make decisions in really uncertain times, is just remind ourselves that people have to live somewhere. Short term, anything can happen. Sure, short term, people can panic. Short term, there can be aggressive price movements up or down. But medium to long term, property needs to move to the fundamentals. And here are the fundamentals. A lot of people talk about them, but in our minds, being in property for 20 years, here's what they are. Strong demand. So we have a baseline natural increase in Australia, so natural births coming in 140,000, and a strong migration intake of roughly around 200,000. Now that's been coming in for the last 5 or 10 years. And yes, our overseas migration is going to be at zero for a period of time. But as soon as the borders are back open, we believe that Australia will be a highly desirable place to live. And we believe that we will revert back up to that 200,000 population mark, which will be part of our medium-term fundamentals. There's a current undersupply, and I'll go into that in a little bit of detail, and there's an ongoing constrained supply, and the RBA put out a paper recently on this, and the basis of the paper is simply that it's too hard to get projects through planning in a timely manner. And so for the next 2 to 3 years, we think there's going to be an ongoing constrained supply, and therefore the undersupply will be there, and we can talk about in which markets that'll be most apparent. We know that the RBA have inflation targets between 2 and 3%. That inflation should make its way through to income growth, which should make its way through to rental growth, which should be capitalised into the price of real estate. So it's a key fundamental and one of the reasons why property is so attractive. We have an organised government. Now, this might be, you might be laughing if you're sitting in Victoria saying the government's not organised, but I'm referencing this to previous serious property crashes in Australia. One being the 1930s and the one prior to that being the 1890s. And the property markets came off between 20 and 50% in both of those crises. But the government it was chaos. There was no organisation. They weren't able to support the economy in a timely manner. They didn't have access to data. And the way things were running then are completely different to now. So you're seeing the government stimulate the economy quickly. You're seeing it trying to target that stimulus now. And I think the government, are playing a key role in how the market is going to behave in the short to medium term, and in fact the long term. And efficiency gains from technology or infrastructure are historically priced into the value of real estate. So what we're seeing at the moment is the work from home movement, basically by force, but I think employees are working out that, their staff, employers are working out that their staff can be just as effective working from home. And therefore that opens the possibility up for a lot of people to work from anywhere. And that should, reprice certain real estate markets across the country. Mostly the key lifestyle regional markets will probably outperform their capital city counterparts. And I know that's been well documented, but it's worth saying that anytime there are some efficiency gains, like I can work from the Mornington Peninsula, in theory, that's priced into the value of real estate. Now, efficiency gains in the past may have been a train line, going out to Yarraville, for example. But now we're talking about, different types of efficiency gains that are priced into property. These are the last 6 economic contractions. And so our philosophy of performance property and the way we build portfolios is to always be expecting an economic contraction. It shouldn't be a surprise. It should be part of your strategy. Importantly, this is a health crisis, but it's led to an economic crisis. And this economic crisis, if you put your strategy together correctly, should come as no surprise. And we certainly talk to our clients about economic contractions at length. And here is the last, since 1970, how the share market has reacted to those economic contractions and how the property market has reacted to those economic contractions. So the blue line is how the All Ords performed. And you can see it's been very volatile. And in 72, 82, 1990, 2001, 2008, and most recently now, you can see the share market fell nationally after every single economic contraction, right? When we look at the property market, national property price movement, you can see after the 72 recession, property prices went up. You can see after the 82 recession, property prices went up. You can see in 1990, property prices nationally went up, only marginally, but still went up. And you can see after 2001, nationally, property prices went up. Similarly with 2008, GFC, a lot of people forget, nationally, property prices went up. And most recently, we're yet to see what nationally year on year happens to the property market. But what I want to leave the attendees with, if nothing else, is economic contraction doesn't always mean property prices must fall. And share market falls doesn't automatically mean property prices must fall. And in fact, history that we have really strong data on suggests that after these economic contractions, the property market has a strong probability of going up. Okay, so we're not buying into the fact that the media is saying, that the market's going to fall. It's just a matter of how much. We're open to both the market rising or falling, depending on what's happening with the data that's coming through our research department. So what are the key drivers of property? We'll talk about them and then we'll provide our conclusions. So here's demand, the demand and supply. When we look at demand, this is the supply side. So is it the supply side? Sorry, I'm trying to, yeah. So the construction peak was in 2015. So as you can see, over the last 5 years, we've been building less and less property, right? And if we go back to the previous graph, over the last 5 years, there's been a pretty strong amount of population coming through. And what that has resulted in nationally, even in COVID-19, even in the borders being shut, is nationally vacancy rates have fallen year on year. Okay, so it's hard for a lot of people to fathom. Okay, our borders are shut, but our vacancy rates still coming down. Now that's been able to happen because we simply haven't been building enough over the last 5 years, right? So it's a real positive that we went into this crisis undersupplied because it's going to determine how the market behaves moving forward. Now, as you can see, the vacancy rates in Melbourne have spiked. The vacancy rates in Sydney have also risen, but the vacancy rates in Brisbane have come off. The vacancy rates in Adelaide have come off a very low base. The vacancy rates in Darwin have come off. Canberra, Hobart, they've remained the same, and the big move has been Perth. You can see that the vacancy rate in Perth has come off quite considerably. So whilst there are markets that may come off, there's also markets that may rise. Now, what we're seeing with Melbourne and Sydney is Melbourne and Sydney receive the lion's share of overseas migration. And so you're seeing a lot of Airbnbs put back out to the market. We're not getting an overseas student intake, so a lot of those properties are going vacant. And in Melbourne and Sydney, especially in the apartment sector, we're seeing rents come off anywhere from $50 to $150, depending on the price point, pretty much straight away. And whilst the borders are shut, we can expect very soft rental markets in Melbourne and Sydney, all right? But conversely, in Brizzy, in Adelaide, in Perth, where we're directing a lot of our investor capital, rents are arguably rising across the board, right? And I think that's important for everyone to just digest, to say, okay, well, there are markets where rents are rising around the country, even with the borders, when the borders are shut. Now, when the borders open, these vacancy rates should come off even further. This is a bit funny. I apologise, but hopefully, Fuzzy, hopefully you can see it. What I was talking about in the very first slide was nationally, we've got a stock shortage, and this is the year-on-year change of properties for sale, properties that are listed for sale. And as you can see, nationally, we've got 7% less stock on than we did this time last year. And when we're talking about quality real estate, when we're talking about quality houses, the sort of things you may want to buy as a home buyer or that you may want to invest in as an investor, that stock is even reduced even further, right? So this is one of the biggest drivers in the marketplace at the moment, low stock volumes, and certainly in the markets that we're buying in, lower vacancy rates. So demand exceeds supply. That's the basis of what we're seeing at the moment. Demand does exceed supply, not everywhere, but in most of the markets that we're looking at the moment. Now, affordability, the significance of the cash rate being at 0.25 is real, because most investors who have bought property in the last 5-10 years, if they go back to interest only, all their properties are cash flow positive. Most investment deals outside Melbourne and Sydney houses that have very low yields, most investment deals that anyone will go into now from a property perspective will be cash flow positive on an interest only loan. It's the first time that's happened across the board almost since 2001, where the market went really aggressive. The significance of properties being cash flow positive, the inverse of that is, for renters, it's cheaper for them to buy property than it is for them to stay renting, right? So in theory, we should get a groundswell of renters stand up and say, hey, it's $500 a week for me to rent this property. It's $450 a week for me to buy this property. Why am I renting? And certainly when Phil and I saw those conditions in Sydney in 2011, the market doubled in the next 5 years. Mortgage interest is 25 to 35% cheaper than 18 months ago. And that means simply people can borrow more. And our view is they will, especially if demand exceeds supply. And every major city or town is almost at the lowest affordability point it's been when you look at a debt service ratio. And if it's not at its lowest point it's ever been, it's at 10-year affordability lows. And to show you that visually, to show you how affordable Sydney is, and I know that's a strange thing to say, but at the moment with these low interest rates, 41% of the average wage goes to the average new mortgage, principal and interest with a 20% deposit. The last time Sydney was this affordable to service a mortgage was back immediately post GFC. And immediately post GFC, the red line here is the year-on-year price change. The year after the GFC, Sydney jumped 20%, and a lot of people forget that because people think GFC, things must have been bad, property prices must have come off. They actually didn't. In Sydney, they went up 20%. In Melbourne, you can see post-GFC, prices in Melbourne went up 20% as well. And that's because they slashed interest rates immediately after 2008, and that created affordability, and demand exceeded supply, and the market jumped. Now you can see what's happening here as well. The slashing of interest rates has again created affordability. Right. And so people out there thinking, oh, I'm going to go into Melbourne, I'm going to wait for a deal, I'm going to wait for mortgagee and possession sales. I think what you're going to find when you get out into the market is you're probably going to be 5, 10 people at auction trying to buy property because a lot of people can afford real estate again. Brisbane, as you can see, the most affordable it's been for about 15 years. And the last time Brisbane was this affordable, when 26% of the average wage went to the average new mortgage, the market in Brisbane went up 16%, the year later 25%, and the year after 33%. So basically doubled in 3 years. Similarly with Adelaide, the most affordable it's been for 15 years. And last time it was this affordable, it went at 18%, 22%, 21%. And when we look at Perth, and Perth is the big one, and this is the last one, if I'm boring you, but hopefully I'm not. Perth, the percentage of the average wage that goes to the average new mortgage is 21%. The last time it was at these lows, or 21%, the last time it was at these lows was back in 89. And house price in 89, if you look at this axis here, they doubled in 1 year. So we're very comfortable with where the markets are, investing our clients' money, going into markets. We see it at the moment that, It's not, oh, we should be worried about the market falling. It's we should be worried about positioning the money in before the market actually goes up. When we talk about confidence, because that's what's been shattered. Prior to this crisis, confidence was high. During this crisis, I don't think confidence could have got any lower. And post this crisis, you can feel confidence coming back now that the government have showed their hand and they're stimulating the market. So the summary of the three key variables is demand does exceed supply. The market is extremely affordable, but confidence for the moment is slightly negative. But it looks like demand and affordability is trumping confidence concerns for the buyers that are out there. Here's our view of the national markets. This is my last slide. Basically, we think there's a 60% chance of a rise in Melbourne and a 40% chance of a fall. Okay, so yes, prices in Melbourne could fall, especially if we have a third wave, especially if these economic restrictions stay on longer. If they did fall, this is the most they could fall, 25%. We don't think they could fall further. If they did rise and the market got a run on, I think they could hit about 40%. Same with Sydney. We're already seeing Sydney started to rise. So this is probably 80-20. I think Sydney's already away. I think Sydney's probably on track for double-digit price growth this year. And this is the potential of the Sydney market before it gets capped out from an affordability perspective. But these are our four buying areas specifically for investors: Brisbane, Adelaide, Bendigo, and Perth. And as you can see here, the chances of price rises are extremely strong, and we're already seeing prices rising. And the upside potential is huge, primarily because prices are so affordable, right? So they can run further. That's a summary from me. I'm sure there might be questions at the end. I'll hand over to Phil now for the our current advice to clients. Sorry, one last slide. So medium term, believe it or not, our forecasts haven't changed. The unemployment issues are being trumped by demand exceeding supply and the benefits of affordability. There's no change to our clients other than, because we're in an economic contraction, slightly increase your cash buffer. We're not advising our clients to hold any purchases back. We're saying continue on your existing long-term strategies. And if you're a Sydney, Melbourne home buyer, this is probably the most important point. We now feel that there's a greater probability of price rises than price falls. So if you're sitting back waiting, I don't think that's the right strategy. I think you should be getting on the front foot. And as long as you can find something that you can be in for 10, 15 years and you can comfortably afford the debt, probably moving forward with that purchase. Sorry, Philly, I'll hand over to you now.
That's all right. Thanks, David. We'll make it fairly quick, but we'll just give you a quick update on the commercial office space out here. Look, we've seen fairly significant rises over the last, say, 6 months during COVID, especially here in Melbourne. We've probably seen this biggest rise since the 1990s recession. Melbourne CBD vacancy rates have had probably the highest quarterly increase on record. So we suspect that's probably going to get worse over the next, say, 12 to 24 months. A lot of corporate tenants out there are thinking about how they utilise their space. How do they actually need that amount of space out there, especially around Melbourne CBD and Sydney? So some of those areas are probably a lot of the commercial developers out there are going to be putting a lot more thought in terms of how they're developing these assets over the next 5 to 10 years and whether or not those corporate tenants are going to be taking on that amount of space. Next slide. I think with Brisbane, in terms of the vacancy rate, we've seen a slight rise in Brisbane, but the Brisbane CBD office market appears to be performing quite well because it isn't as, in terms of COVID, it is actually performing fairly well. We've seen a slight rise in the CBD vacancy rate in Perth on the ground, but it's very important that vacancy rate was running at around about 26 to 27% 12 to 24 months ago. So it is trending downwards with some of the research that David's just spoken about in the residential sector. We expect that the Perth vacancy rate to improve over the next 12 to 24 months. But in Melbourne and Sydney we're expecting obviously vacancy rates to increase, given that there is a pretty serious pipeline of new office space coming into Melbourne and Sydney over the next 12 to 24 months. So if you're a business owner, you're a medical client and you're looking to buy your, say, premise between, say, $5 and $20 million, I think there are going to be opportunities out there in that particular space. Commercial office, I'd be very, very careful around making sure you're not rushing into it. We are getting a lot of client inquiry about some of our clients looking to move out of their office spaces and perhaps maybe buy their buildings. We probably think they should be patient for another 6 or 12 months and just see what happens out there in the climate, especially in Melbourne and Sydney. If you look at the industrial, so last year we saw 6 million Australians travelled overseas in 2019. So that probably equated to be around about $43.2 billion worth of discretionary expenditure going out of the country, and that averaged to be around about 7,200 a person. So pretty high numbers when you look at that. Now, a lot of that money, we believe, is probably flowing back into Australia. We think once the state borders open up, a lot of that money will flow into tourism. We think it's probably going to have a positive effect on Australian tourism over the next 12 to 24 months. That in checking that, the demand has been driven by some of these defensive occupiers. So those industrial type assets out there that are more defensive, you know, e-commerce, transport, pharmaceuticals. We seem to think that those sort of asset types will be performing quite well. Next slide. So industrial face rents, I think they've remained fairly stable, but we've seen some of the developers out there building some of the new stock coming in. They've had to offer some rental incentives to kind of maintain those rents. Land values in Sydney probably remained fairly flat over the last 6 or 12 months. We've really seen no change to the average prime cap rate. Obviously in Sydney, we've seen slight decreases in some of the other cap cities. We're seeing a lot of activity for our clients looking for more defensive type assets. So the problem with the industrial sector that the yields, say 3-4 years ago, were running at 5.5% to 6% to buy a really good quality industrial asset around that 10 to 20 mil space. We've seen those yields really start to come and contract, and for a really good quality industrial defensive asset for around that 10 to 20 mil space, the yield compression's now gone to below, say 4.5%, even 4.25% for some of these asset types. Retail, so as we know, the last 5 or 6 years as a result of online shopping, a lot of these retail vendors and landlords have really had to rethink about how they reposition their particular assets. It's been particularly volatile, especially for discretionary spending. We're expecting further volatility over the next 12 to 24 months. We've seen that online shopping, everyone's aware of this, but it's increased by 50% over the last year. So I think a lot of landlords out there will really need to reposition those particular assets. The smart landlords out there have already been doing that for the last 3 or 4 years. And as a result of COVID, that's accelerated some of these landlords here in Melbourne really trying to reposition and look at what sort of tenant and making that particular retail shop attractive for a business owner or a different type of tenant wanting to rent those properties out. Queensland, funnily enough, has been probably the strongest performing state in this space. We're seeing tenants aggressively negotiating rents. You know, you look at Oxford Street up in Paddington, up in Sydney. You know, those rents are off 25 to 30%. You know, a lot of tenants are going back to their landlord. And if the landlord tends to look after the tenant, we believe that, you know, if they can perhaps maybe look at that relationship, we can perhaps maybe make sure that they're protected and they've got that incoming rent continually coming through. If we look at if we go back a slide, David, if you look at our 11 main retail shopping strips here in Melbourne, that's gradually increasing, and that's the result of the online shopping. But you look at the vacancy rate here in Bridge Road, Chapel Street, here in Paran, the vacancy rate is above 20%. So that's slowly been creeping upwards for a number of years now. Some of those landlords, they've fully paid off their retail shops, so they're unwilling to adjust their rents right now. But if they do want to put a really good quality tenant, I think they're going to have to adjust their rents over the next, say, 6 to 12 months. The problem is if one of those particular landlords adjusts their rents, it's going to create that comparable for all the other retail shops on that strip. So our current advice to our kind of commercial and industrial clients, you know, looking to buy really good quality blue chip assets, our medium to long-term fundamentals haven't changed at all. We're obviously setting up a commercial and industrial fund that we're obviously putting some of our private clients into and looking at particular opportunities out there. But we've been extremely selective in terms of what we're buying. There's evidence of buying it below replacement value starting to appear in certain markets. So if you're willing to be patient, you know, we're looking at, you know, for every 100 properties, we might find a really good opportunity where we're getting it as close to land value as we possibly can. Obviously, retail and commercial tenants are really out there. They're negotiating aggressively, given that they want to stay in their particular building. So if you can look after the tenant over the next 2 to 3 years, I think they'll stick with you long term. For Melbourne and Sydney investors, I think if you're a business owner, I think there's going to be good opportunities for you to consider. But if you're a business owner, we're obviously seeing the hotel sector obviously has been affected quite heavily. That's due to overseas migration, obviously the export education sector here as well. So a lot of the office sector here in Melbourne is struggling in that particular space. But look, from an overall point of view, we're not holding back buying in our core buying markets, but we're being extremely conservative and we're really willing to be patient in our non-core areas. So that's pretty much it from a commercial industrial point of view.
Thanks very much, Dave and Phil. Very informative. Really appreciate, obviously, the presentation that you put together. So thank you, guys. Just a quick question from me. We do have a bit of a quiet group actually online today because there's only one question in the Q&A. So I might fire a question at you, Dave, if I can. And please, if you've got any questions, please put them in the Q&A section down the bottom. Dave, you mentioned that from an investment point of view, you're buying in the areas of Brisbane, Adelaide, Perth and Bendigo. Can you give us an example of a transaction that you've just recently done where you've purchased for a client within those areas? Obviously, investors are looking for a good yield and capital growth. Can you give us an example of what sort of yield you're achieving and what the long-term capital growth perspectives are for a particular asset you've bought?
Yeah, that's fine, mate. So when we go into regional Victoria, so Bendigo, the purchase price is around 400K.
Yep.
The yields at the moment are between 4.25 and 4.5. That's gross. And what we're buying in what we call triple B suburbs. So most regional areas don't have AAA suburbs, and triple B suburbs essentially have long-term compounding growth between 6.5 and 7.5. Right? When we go into Brisbane, we're buying in AAA suburbs.
Yep.
And AAA suburbs have long-term historical growth above 7.5%.
Yep.
The yields there are about 3.25% gross.
Yep.
Right? And the entry point is around 700K.
Right.
Okay. When we go into Adelaide, 600K is the entry point, and when we go into Perth, about 650 is the entry point.
Okay. So if you're an investor, you're borrowing money at, let's call it, we'll jump into this a bit later with Alex, but let's call it 3.5%. So you've got a positive cash flow and some really good opportunity for some capital growth in those assets held long term, obviously.
Yeah.
Correct. Yeah.
Most of those assets are neutrally geared from day one. If you can actually get that yield above, say, 3.5 to 4.5%.
And if you guys can get the money at 1.5, then we're laughing, yeah?
Oh, mate, that'd be nice. Absolutely. If the banks could drop their rates, and we'll touch on that a bit with Alex as well. But there should be some stuff coming from the RBA in November, hopefully, around that, which would be nice for everyone. But I think going through this period and through COVID and post COVID and having a low interest rate environment is definitely propping up the property. The property market, as you've mentioned in your presentation. So if it hadn't been for that, who knows where the property market may be. There is some good questions that are coming through now, just through the Q&A box. So I'll just have a quick brief look here. Just a question on the views on price strength in housing in rural Victoria. So that one's...
So yeah, look, I think rural Victoria should do better than Melbourne. How well Melbourne will do will be up to, how long these economic restrictions hang around for. But look, our view at the moment is Melbourne should do around 20 to 30% in the next couple of years, largely because of low interest rates. That's in the housing sector. We think regional Victoria will probably do better than that. Geelong, we were in 5-6 years ago for clients, and that market's already up about 80% for clients. So Geelong probably doesn't have that far to rise. Probably it will rise in line with Victoria, maybe a bit better. Ballarat's got a bit of room in it. We were in Ballarat 3 years ago.
Yep.
But Bendigo's our pick of the three because we think it's the market that's closest to the bottom, right? Yep. With all the lifestyle markets around, but there's only so much time we've got. So,
yeah, the affordability index here in Melbourne is still relatively stable, but people will eventually get pushed out into some of these lifestyle type destinations, and we're seeing a lot of activity around the Mornington Peninsula, the Bellarine Peninsula. And for 500-600K, rather than buy a 1 or 2 bedroom apartment in Melbourne, you've actually got the ability to buy a really good quality house in these regionals at that level.
Yeah. Yeah, very good. Another question that's come through for Dave and Phil. What hot tip for long 5-year up to $10 million property investments do you have?
I would probably need a bit more information on that one. Like if you're investing 10 mil, we really need to look at everything else that's going on and get some more clear objectives on whether that's growth focused or income focused. I think there's good opportunities in both the resi and commercial markets, but I would want more information before we answer that question.
Yeah, maybe one for Justin to reach out to Dave or Phil on that one.
Yeah.
Very good. There is news of gold being found in and around Bendigo. Does this have anything to do with the growth in these areas, do you think? It's a bit of a random one there for Mike.
Well, that could be a trick question.
Yeah.
I don't think, no, you're best at answering these questions, mate.
Look,
make it up.
I wouldn't be basing your investment-based decisions based on those sorts of calls. I'd probably look to the fundamentals and stick to that. But thanks for the question.
I think property is the modern day gold up there. So,
yeah. We might pull one more question out and then we'll move on to Alex, just in lieu of time, and we'll aim to get back to everyone's question obviously after the webinar. So we've got everyone's email address, those that have registered. Just one last question. Do you have any insights on vacancy rates in other commercial properties, warehousing, off high street retail, etc.? That one's just come through from Thomas Marn. There for you, Phil. I'd say you're best placed to answer that one.
So whereabouts? So basically around those particular areas he's asking the question for?
Yeah, vacancy rates in other commercial properties, so warehousing, off high street retail.
Maybe Melbourne, Philly, I think. Perhaps.
Yeah, just in Melbourne, yeah.
Yeah, well, you've got to look at the asset type, so if it's warehousing, there could be the ability to redevelop that existing asset, but we've got to be very careful that it is going to be attractive for that particular tenant moving in. So, vacancy rates for that particular stock, you're still looking between say 8 and say 10% for that sort of asset type. So you've still got to make it as attractive as possible for the incoming tenant. And hopefully you don't have to upgrade or the building itself in terms of doing a fit out, because it's obviously just the warehouse itself. So I'd still be very careful about making sure that you made the rent as attractive as possible in this market.
Yeah, good response, good advice there. I might just ask one more, because there's been one that's come through that's probably pretty topical. Do you help clients with property strategies such as subdivisions, developments and renovations?
Yeah, we can provide the high level advice. So we're not actually doing the town planning, and we're not actually, doing the project management work, but we can certainly assist in whether the decision is a good decision or not to go down that path.
Yeah,
definitely part of what we do.
Yeah. So if you're looking to do any subdivisions or anything like that, then please feel free to touch base with Dave and Phil from Performance Property Advisory. Thanks, guys, for the content. We might just jump on to Alex and just do a bit of a Q&A with Alex. How are you going there, Alex?
Good, thank you. Thanks, JK.
Very good, mate. You're in the thick of dealing with the banks day in, day out, and what clients really want to know, and no doubt some of our attendees are interested in, is it more difficult now, given the current environment that we're dealing in, to access funds? What sort of policy changes and criteria are happening across the banks, and how you're seeing things, I suppose?
Yeah, so definitely since March this year, when COVID first hit, lenders have made numerous changes to their assessment criteria, and they have adapted to the evolving COVID environment. And it's great that the banks have continued to lend money, although on the other hand, it has made applying for a loan is a more complicated process to what it was. And it also means that assessment criteria now is quite different when comparing each of the lenders. So one of those examples of recent changes includes changes to maximum debt to income rules. Now, some lenders have introduced this, and the calculation of debt to income is your total loan amounts against your gross income. And this debt to income ratio puts a ceiling on the maximum amount you can borrow. Now, certain lenders have since adapted a more conservative ratio, and it does depend on the LVR and how much you're borrowing against the property. But typically we'd say, an 80% LVR, debt to incomes have reduced from 7 times down to 6 times. So it's important to understand because it impacts the borrowing capacity of an applicant.
Yeah. And that's total debt, is it, Alex? Is that, incorporating home loans, car loans, all that sort of stuff?
So basically total limits of all your debt. against your total gross income, and that includes any rental income that you might receive as well.
Yeah. So the banks typically want to see that multiplier under 6. Is that right? Is that the ultimate position for them?
Ideally, yeah. So, and it does depend on how much you're borrowing against a particular property. If it's below 70%, they may be more comfortable with a 7 times multiplier. But if you're borrowing 80% and upwards, it's typically 6 would be the cap.
Okay. So if we've got clients sitting at home and they're wondering what's my maximum borrowing capacity, and they're thinking of, the next purchase, a quick calculation for them is the DTI calculation that you mentioned, debt divided by gross income. And if that's under 6, then there's potential there to them to borrow money.
Yeah, correct. Yep.
Yeah.
And, some further policy changes that really impact borrowing capacity. Some lenders have strongly reduced the percentage of bonus income that they'll accept for certain industries. Some lenders might be shading commission income down to, by 40% down to 60% that can be used for debt servicing. So it really has a material impact on the borrowing capacity of applicants like real estate agents who are paid mainly in commission.
Yeah. And where were they previously? Was that sitting at sort of 20% shading or something like that, was it?
Yeah, typically, lenders would take 80% of bonus income or commission income. There were some out there that would use 100%. It really does depend on the industry. But again, that's a pretty significant shading that can impact someone's capacity.
Yeah. Okay. And tell me about interest rates and let the viewers know about where you're seeing interest rates hit at the moment, Alex. For obviously you've got the 4 categories. You've got owner-occupied P&I, owner-occupied interest-only investment, P&I and investment interest-only. Where are you seeing the market, mate, at the moment?
Yeah, so in the home loan space, it's a competitive market and lenders are keen to win new business. And obviously that does impact the sharp rates that are on offer at the moment. So if we're talking owner occupiers, principal and interest rates, variable rates, we're looking at between 2.6 to 2.8 as the sharpest offers in the market at the moment. If you're then willing to fix in a rate for say 2 years, rates are in the low 2s, so you could get 2.19% for a 2-year principal and interest fixed rate. When we're looking at interest-only repayments, they are a margin higher. So for a fixed rate, you can get around the 2.8% mark, and for a variable rate, around the 3% mark. Yeah.
So it's good. It's cheap money out there still, obviously, and very attractive if you're looking to, get into a property like as Dave mentioned, where you're sort of yielding at 4.5 with a capital growth rate at 7-8%. Sort of makes sense, doesn't it?
Yeah, that's right. So they're obviously owner-occupied rates. When we're looking at investment rates, interest only, you're in the low 3s. Potentially fix them in, you can get 2.7 on a 2-year fixed rate interest only. And then the P&I rates, where you're paying principal and interest, far sharper as well. So you could get a principal and interest fixed investment rate in the mid 2s, which is very sharp.
Yeah, it is very sharp. It's good money.
And in addition to those sharp rates, there are some pretty strong specials in the market as well, just to encourage investors or owner-occupiers to switch their home loans across. And most banks are offering at the moment either a $2,000 bonus or a $4,000 bonus just for refinancing your loan to a new lender. So, if you haven't reviewed your rate or your deal for 12 months, now might be the time to see if you can save on your repayments, obtain a sharper rate, and collect $4,000 cash bonus while you're at it.
Yeah, absolutely. And what's the general cost on a refinance? So does that cash back sort of alleviate the cost of a refinance out?
Yeah, so assuming there's no break costs, which can apply for fixed rate loans.
Yeah.
The main cost you're paying are government fees. So it might be $400 to $500 in government fees that you'll have to incur for switching your home loan to another lender. So those sorts of cash bonuses definitely cover off on those costs.
Yeah.
I should add as well, there's even a particular lender that are offering $4,000 for your first refinance and $2,000 per additional security. So if you're a homeowner with 3 investment properties, you might be looking at a $10,000 cash bonus just for refinancing.
Yeah, so you can get a bit of cash up front in hand, and then obviously save some interest over the over the life of the loan by having a potential look at a refinance. And I know personally we have been doing a lot of the refinance stuff because people have got a lot of time on their hands at the moment, and they're looking at their financial situation, and just working out whether or not there is some better offers in the marketplace. So we've certainly been pointing the clients in the right direction, and getting some really good strong deals out there with cashback and good interest rates.
Yeah, correct.
Talk to me about the budget and what sort of effect some of the budget announcements that we've just recently had. Obviously, the federal government come out and with some stimulus packages there. How does that affect the finance world, and what are the key aspects that have sort of come out of that budget that affect our borrowers?
Yeah, so I'll quickly touch on some of those stimulus measures. The home builder grant, most people would have heard of that, but that's still in place until 31 December. Provides owner-occupiers with $25,000 grant to go towards construction of a new home or significant renovations to an existing home. So what they want to do there is essentially assist the residential construction market and encourage the commencement of new builds. Like I said, that's up until 31 December, and construction needs to commence within 3 months after that. There are terms and conditions in relation to income caps and the value of constructions and renovations. So if anyone's interested in that, please reach out, and we can provide some further information.
Yeah. And tell us a bit about the responsible lending and the changes there that's happening. The announcement from the government around the changes that are happening from a responsible lending NCCP process as of March next year. Will that make a lot easier for people to borrow money once these changes come about?
That's the aim of the game. Josh Frydenberg announced that a couple of weeks ago to overhaul those credit practices and amend responsible lending laws. So essentially the purpose of that is to promote consumer confidence and have the banks sort of expedite loan applications and write more business. Essentially, it'll come down to a simplification of credit policies. And some are suggesting as well, it's a shift from lender beware to borrower responsibility model. So allowing lenders to rely on the information that's provided by applicants as part of the loan application process. And I think what it will actually relate to is lenders no longer being solely responsible for verifying general living expenses declared by applicants. And there may be more of a reliance on banks to rely on the standard benchmark, the household expenditure measure used to estimate annual living expenses based on a client's income, location, and number of family members. So it doesn't come into effect until next March. So we're yet to understand exactly how the banks will react or what kind of changes will be implemented. But we would expect, based on everything that's come out, a more streamlined approval process because, obviously, it's not a straightforward process now to apply for a home loan.
Yeah. So you would think as of March that should drive more people into borrowing money and hence obviously investing in property, as Dave mentioned in his presentation. The flow of credit has been quite good for credit-worthy people. But as of March, there may be more people that become creditworthy, given the bit of a relaxation in the responsibility of lending to a person looking to borrow money for a home loan.
Yeah, that's right.
Alex, is it fair to say, sorry, Jamie, is it fair to say that with this debt to income metric that you're talking about earlier, which seems logical because it's so easy for the banks to ascertain quickly, are they going to run with the debt to income and then scrap the verification of expenditure because it's so difficult for them to get to the bottom of that and for that to be accurate? Do you know what I mean?
Look, as well as the debt to income, there's obviously the debt servicing assessment criteria that needs to be met as well.
Yeah.
So whether it's a combination of debt to income, serviceability assessment, and the adoption of a standard, household expenditure measure for general living expenses, as an ex-banker, that would definitely simplify the process. But really, it'd be interesting to see what the banks come out with this prior to March next year.
Yeah, and you would think a lot of those changes will relate to just the, you know, I suppose the checking that they do in terms of the documentation that comes through. So they might just rely on, you know, call it 1 year's financials instead of 2, instead of diving really deep into clients' living expenses and going through their credit card statements and look at what they're spending. They may just adopt a, you know, an approach where they agree with whatever the documentation is that has been provided by the client, and use the HEM as a standard measure. So I just think it'll cut down a bit more of the red tape and get that flow of funds out the door a bit quicker. So it'll be interesting to see what comes out of that in terms of policy changes.
I think it's a really good point, but I think some of the banks really struggled with, they were giving out funding to people buying questionable assets, and that was a big thing for us. And I think if people can make sure that they're buying the correct asset type, that will grow in value. And more often than not, we have our clients come to us buying the wrong type of asset. It's going to set them a number of years behind. So I think it's about asset selection as well that they need to get right.
Yeah, I agree. 100%.
And I think, interestingly, like us as a business performance property, when we've always mapped it out, we thought debt to income at 6 was the max anyway. Like, I don't see how one can live on debt to income past 6.
Yeah.
So it just seems if they could adopt that, then everything becomes simple in terms of how much can you borrow. Well, times your income by 6.
Absolutely. If only the world was that simple, Dave.
Yeah. Yeah,
it would be lovely. But yeah, it's interesting that they are adopting that approach more so than they have in the past. So maybe you are right. Maybe you're onto something there. They will just use that measure more and more, and just, you know, and cut down the red tape as we move past March and the responsible lending changes.
It's a good point, because the Royal Commission, obviously a lot of the funding that they were giving out was done fairly strategically, and they were a lot more conservative this time around. So the number of distressed sales that we probably expect to come onto the market won't be as high as I think was what the general market are expecting. So it's probably a blessing in disguise that we went through this process as well.
Yeah, exactly right. Well, lending criteria has become a lot harder. So, you know, when they do get into these situations, the situation's not as bad as what one would first have appeared. Well, not like it was in the US with the mortgages that they were writing. So we saw obviously the global financial crisis. So,
but Jamie, we think that these rollbacks of these responsible lending laws will actually mean credit is easier, and therefore the money supply will come into the market faster. Yep. And therefore, for a period of time, you know, growth should be aggressive, and we're just encouraging our clients to consider getting their long-term strategy on foot prior to sort of the middle of next year.
Yeah. And I think you make a good point there. I was looking at your charts, Dave, just you know, and you mentioned that the prices rise after we have an economic event like a GFC, like a coronavirus. But in the graph there, it sort of did come back down a little bit. But obviously, you know, you got to get your strategy right from a property perspective. So if it's a long-term strategy, 10 to 15 years, the fundamentals will come to the fore, and you will get your capital growth.
Correct.
So if you've got a short-term strategy, you know, it's never really going to be it's going to be very hard for you to pick the right time in the market to get into that property.
Absolutely, man. And we don't really engage in short-term strategies, period. But finding value in the market is a key component of our long-term strategies. So, you know, but I just think that the notion that's out there that the market's going to fall, certainly Phil and I are really strong on the view based on the data that it's not the case. And if anything, what we're seeing right now is the precursor to the market actually about to rise almost across the board.
Okay. I mean, it's obviously a big factor at the moment is supply and demand. So there's a lot of pent up demand, not a lot of supply. With the spring coming on board, and as the supply increases, do you feel that may catch demand and prices may plateau out in Melbourne and Sydney in these key areas?
It's possible. It's possible, and that's always the unknown. Like, we could get a huge volume of quality stock hit the market, but we're not seeing that. I mean, we're always seeing the market 3 weeks before it hits realestate.com because of all the discussions we're having with all the agents. And in Melbourne and Sydney, it looks like demand's going to exceed supply until the end of the year.
Yeah.
And then it's impossible to forecast because we don't know what's coming through, right?
Yeah.
So, but if we think about what's coming next year, you got these lending laws being rolled back. You've got a bit more confidence after the COVID crisis, probably people returning work, the unemployment rate coming off. So next year, even if some more stock does come on and the supply and demand balances up a little bit, it's probably going to be more competitive because you might get more buyers come in who weren't in this year, who wanted to sit on the sidelines because of the uncertainty. So,
but the biggest issue now is that overseas migration has stopped. What happens when overseas migration opens up again? They bring out the vaccine. Obviously, a lot of developers out here in Melbourne have found it very difficult to get funding to build these new apartments, good quality owner-occupier apartments. So that particular sort of asset, the older style units in Melbourne, there's probably an argument that you may see some uplift with that sort of stock as well.
Yeah. Yeah, good point. All right, I think we've run out of time today, guys. Really appreciate your time, Phil and Dave. Obviously, all our listeners out there, if you're looking at that next property acquisition, or you're looking to build a property portfolio and maintain that portfolio, please feel free to reach out to Dave and Phil. They're always happy to take calls. Alex, thank you very much, mate, for your input from a finance perspective and giving us an update there. And hopefully our listeners today have got something out of today. And we appreciate you tuning in, and we'll look to maybe run one of these again soon.
Thanks, Jamie.
Thanks, guys.
Thanks, guys.
Cheers.
Bye.